Should the weak dollar worry us? Welcome to the call. I'm Jay Sapsford. The U.S. economy is growing, earnings are solid, and the stock market is holding pretty steady. But the dollar has slid to a 4-year low, while gold, the traditional dollar hedge, is sitting at record highs. U.S. debt has now reached levels unseen since the years after World War II, and then you throw in some erratic policies out of Washington, and well, you start to hear this narrative that investors just might be souring a bit on the U.S. So today's question: are the markets flashing warning signs? Joining us now is Tim Adams, President and CEO of the Institute of International Finance and formerly Undersecretary for International Affairs at the U.S. Treasury. Tim, welcome to the call.
Hey, Jay, thanks for having me. It's a real honor to be here.
Well, let's set the table with the dollar, which is down by more than 10% over the past year and now near 4-year lows. What's driving the decline in your view?
Yeah, well, we have flexible exchange rates, so the dollar moves around for a whole host of reasons, and it has been highly valued for a number of years,
Hmm.
which has created real pressure on manufacturing and exporters. It's been great for importers and for consumers, and for those of us who travel around the world a lot, it's been a blessing, right? You actually afford to stay in nice hotels. I think what's happened is there are some cyclical effects going on, but there's differentials between the expectations for U.S. interest rates and interest rates in other jurisdictions. Those interest rate differentials will drive currencies. And there's an expectation that rates will continue to come down. You have a new Fed chair who's been announced, Kevin Warsh, a good friend of mine who I've known for 25 years. But I think there's an expectation that Kevin, once chair, will push as hard as he can to get rates down. That's what the president wants. Is what the president selected him for, and that, as well as some concerns around the world and a lot of financial and political capitals about the policy trajectory of the U.S. And just geopolitical risk. I think there is I wouldn't say people are exiting the U.S., but there's a certain sense of caution about how much more you want to continue putting into the U.S.
Okay, so I'm asking my producer, Scott, to throw up a chart of gold prices. You'll see that gold has more than doubled in the past 2 years. Some see this as a sign that investors are seeking an alternative to the greenback. I just wonder what your take on this is.
Yeah, I'm on a foundation board. We met this week, and someone reminded me that a year ago I suggested we should sell some of our gold and get out of our positions. I did because I thought it reached pretty high levels, that we left a lot of money on the table because of it. But look, if you're going to get out of the dollar, you're looking for alternatives. There's not a lot of places to go. There's not a lot of depth. You can go to euro, yen. There are other currencies. I think gold has been a safe haven for numerous cycles and has been now. Other metals have rallied and also moved down. Silver, for example, which is more of an industrial metal than precious metal, has seen a rise and also a bit of a drop. So each one of these move for a variety of idiosyncratic reasons, but there's no doubt that gold has been receiving lots of attention for a number of years now. Even central banks have been trying to diversify away from their dollar holdings.
Now, the president was speaking the other day. He seemed kind of indifferent to the decline in the dollar, presumably because it's good for exports. But I'm wondering, doesn't it make it harder to entice investors to fund our deficits when the dollar's on a weakening trajectory?
Well, you have to bribe them with higher interest rates. So, yes, there's no doubt that President Trump likes a weak dollar, a cheap dollar. He wants to focus on, look, I don't mean this pejoratively, but he's a mercantilist at heart, right? It's about exports, not imports, and it's about selling rather than buying. Although, a third of U.S. trading goods is really intermediate goods that are within firms. So, and those goods go on to be included in exports. So even if your imports become more expensive, it also can hurt your exports too. But yes, I think the White House certainly would like to see a weaker dollar. Secretary Bessent has done his best to continue messaging, and he's even messaging today that he believes in the strong dollar policy. That if they put the right conditions in place, that capital will continue to flow into the U.S. There's an old adage: "Capital is a coward; it goes where it's treated well, it flees where it's treated badly." So I think the secretary thinks if you can put in the right enabling conditions, capital will continue to come here, and he himself has pledged not to use the currency as a competitive weapon. The White House may be in a different place.
Now, Tim, the fate of the dollar is closely tied to demand for U.S. treasuries. So we're putting up another chart here, this time looking at the rising levels of global debt. Over the past 15 years, public debt has more than doubled and now sits above $100 trillion. We should note that $38 trillion of that, more than a third, is the US alone. So here's the question. Are these numbers as scary as they sound?
Yeah, they're very scary. If you look at just last year, and we have a global debt monitor, our next one will be out in just a few weeks. Just last year, we had probably close to $40 trillion worth of delta increase in global debt, over 340 trillion, 340, 350% of GDP. The advanced economies alone are 115, 120% of GDP. And these are economies like Europe, US, China, and Japan, where we have huge demographic challenges, right? We have aging population. We have very, and it depends on the jurisdiction, but we have social safety nets, which are going to be, in the U.S. especially, which are strained and will be even more strained over the coming decade. We're all going to spend more on defense, especially in Europe. So we've got huge demands on our budget, and we're running record levels of debts and deficits at a time when debt levels are extraordinarily high. So I find it incredibly harrowing. It's something that keeps me up at night. But as you know, there's not a lot of concern in this town right now about these issues.
Well, one of the solutions to this seems to be that we've got to raise, particularly demographic issues, we've got to raise productivity and growth. One of our members is asking, are these record debt levels going to impact growth, whether through higher rates or simply crowding out private credit?
Well, when you're in global capital markets, you're attracting capital every day. And back to your point, if you have a weakening dollar, interest rates are going to have to compensate. So you'll see a backup in rates. And indeed, if the Fed were to pull down its balance sheet, we've got 6 trillion sitting on the Fed's balance sheet. The incoming chair, assuming he's confirmed, I assume he will be, Kevin Warsh, has made many statements over the last few years. It's time to reduce the Fed's balance sheet. So that's a supply issue as well, in addition to running deficits. So I suspect if you just all of the things held constant, rates are going to have to be attractive enough to attract foreign capital, and that's a challenge. It's a lot of different opportunities out there. So you've got to be the most attractive person on the stage. U.S. has a lot going for it, without question. It's a vibrant economy, deep and liquid capital markets, enormous amount of opportunity for investment, but we can't take it for granted. And that's my concern, is that we take it for granted.
Well, trust is an enormous part of that, and I know that you've done a lot on trust. What role does trust play in buoying the dollar and keeping the funds coming in to finance our deficit?
Trust is a critical ingredient for everything. It's marriages, relationships, businesses, currencies. Francis Fukuyama, the famous social commentary, political scientist who wrote the book The End of History, also wrote another book entitled Trust. And he looks at different societies throughout history. High trust societies are more prosperous and succeed and prosper in a way that low trust societies don't. Trust is everything. And if we erode trust in not only in the dollar, but in the Federal Reserve or other institutions in the United States, for the Department of Justice or other things, we certainly will pay for it in the short term and most certainly over the long run.
Well, on that question of trust, we've got another member who's asking whether the tariffs of this administration or sanctions under the previous were seeing the U.S. weaponize financial tools. Doesn't the overuse of these instruments undermine trust in the dollar and dollar assets?
On sanctions, we've had sanctions around for a long time. We've had sanctions on Cuba since the 60s, and North Korea for years, Iran since the 70s. So it is a tool in our toolbox, and one in which political leaders of both parties like to use because it's preferable to kinetic solutions. It's seen as clean, it's seen as providing some leverage, although there's a question about how, in isolation, how effective it is. But it most certainly captures the attention of investors and users around the world, and I think there are many places, many jurisdictions in the world that would like to avoid using the dollar for the mere fact that they don't like being caught up in sanctions related operations. But yes, it's weaponizing the dollar has a cost, uh, but it's a challenge to get political leaders to back off of this tool, sanctions, because it's such an easy tool to use.
All right, I'd like to hear what Citadel's Ken Griffin said on the stage at Davos recently. Let me play you a clip and get your thoughts on the other side of this.
Let's take a step back and talk about where we are right here, right now. The area of recklessness is the spending of governments around the world, who are all, with little exception, all spending well beyond their means. It's a story of the recklessness of government spending.
There's term recklessness, is really one that stuck out to me. And I'm wondering, will today's political realities even allow for less reckless behavior on the part of governments?
Well, Ken has been very vocal. In fact, I'm just having this conversation with several investors yesterday, and it's good. It's good to hear. It's good to hear people with that view. I share his view about the concern regarding fiscal trajectories. In the U.S., we have a debt of 38.5 trillion. That's 120% of GDP. And if you look at debt held just by the public's 30 trillion, and it's continued to grow. So we're growing faster than our economy, and deficits of 6% of GDP at the top of the cycle, right? So it makes you have to ask the question, if the cycle turns, and at some point it will, what happens then? They'll just get larger. So I think the advanced economies, we've all been running large deficits for a long time. We've been pulling consumption forward. And there's nothing wrong with debt in and of itself, if as long as you can pay for it, either in terms of social returns that you find acceptable, societal acceptance, or financial or economic returns. And I'm beginning to wonder whether we're actually generating those kinds of returns. The interest on our debt alone is 2.67 trillion, which is $3.5 billion per day just on interest costs. And there's a limit to how long we can continue doing this.
Well, on that same panel that Ken Griffiths is on, the European Central Bank Governor Christine Lagarde also said that not all debt is equal. How can we what policies should we be pursuing in order to make sure that the debt that we're issuing is contributing to growth rather than just front loading some of our resources from the future?
Well, yeah, look, as you know, debt for capital formation that generates revenue stream where you can pay back your debt's fine. I've got nothing against that. Debt that pays for consumption. When I was in graduate school, I was a poor graduate student. Use your credit card to buy groceries. That's a losing strategy. So we just have to continue to emphasize capital formation, private sector led capital formation in this country. Productivity, which is actually increasing. We do see an increase in productivity. It's fairly narrowly focused, and investment is narrowly focused on information processing and software companies. We need to broaden the base. We need greater capital formation across the economy, and we need to focus on productivity. But borrowing for consumption is a losing strategy, one that will come back to haunt us.
Now, looking at the ways out of this massive sort of debt buildup that we have not only in the United States but around the world, there's really kind of two options here. Let's talk about the first one here. You could inflate your way out of this. How's the bond market going to react if we try to do that?
Well, there are a variety of ways we've learned throughout history. Ken Rogoff and Carmen Reinhardt, two of academics, have written a great book showcasing how different governments and countries and empires over 1,000 years have gotten themselves out of this. Usually, debasing your currency or running inflation so that you can pay back in cheaper currencies. And that varies by jurisdictions. In some countries like Japan, where your domestic population and your domestic banks are large holders of your bonds, that has real implications. You're going to make your population poorer. If foreigners own your bonds and you make them poorer, it's less of a domestic hit, but you've got to continue going to the same foreign investors to keep funding what you're doing. So it in it itself is a dangerous strategy when you're dependent on foreign capital to fund your operations.
You mentioned Japan right now. We saw that hiccup in the Japanese bond market earlier this week. But, we're looking into the numbers on that. The other thing that's sort of escaping everyone's attention is that their debt to GDP ratio, which used to be, the poster child for demographic problems and profligate spending and the rest of it, is actually coming down now. And that's due to growth. Doesn't it suggest that really the most sound, solid answer to this is growing our way out of this?
Yeah, and the challenge for the prime minister, who I like, and I think she has some creative ideas. But she wants to look. She wants to cut taxes. I'm all for lower taxes. The question is, what's the impact on the deficit, and can she generate enough growth from it? And right now, those who are investing in JGBs, Japanese bonds, are concerned that in fact she's going to make the deficit larger. So part of it is just having a policy regime that has credibility. But I agree with you. I'm a big fan of growth through private sector led capital formation. And the other challenge we all face now, even more so than we did a few years ago, is just more spending on defense and national security. Today, the New START treaty expires, the arms control agreement between the U.S. and Russia. We don't really have any left. Jurisdictions, Europe, Canada, other jurisdictions around the world are all going to spend a significant additional amount of money on defense and national security. And that's not that doesn't promote economic growth and capital formation. That is, when you have tanks sitting in bunkers, it really doesn't help you. So the problem is going to get worse rather than getting better.
I've got another question from one of our members here asking, has the public dispute between the White House and the Fed contributed to the dollar's weakness by eroding trust?
It doesn't help. It's not new. I've been in this town a long time. I remember when Nick Brady and Alan Greenspan used to feud in the early '90s, and that was a challenging time. And we know there's a number of stories of LBJ and having disputes with his Fed chair, but it doesn't help. It sends a signal of discord, and it does begin to question the legitimacy and the independence of the Fed. The president has the capacity to offer thoughts on all kinds of issues on economic policy. I would just counsel them to be cautious about the way they treat the Fed chair, the incoming or the outgoing Jay or Kevin, and just defend the institution's credibility globally. Because if you don't, you're going to pay for it in a whole host of ways.
All right. Well, as a final question, Tim, I wonder, you said our debt levels are unsustainable and you're not alone. A lot of people are making the same point as well. What should our audience be watching for to see if we're approaching a trigger point or to distinguish between a potential trigger point and just another false alarm and normal volatility in the markets?
Well, you won't get a political response until voters feel the pressure, and that's when, if the long end were to go up, mortgage rates are at, look, I remember back in the '80s when mortgage rates were 14, 15%, auto loans were 21%. I went to buy a car in the early '80s, 21% auto loans. That is crushing to the economy, and that's when voters become very focused and you get policy response. Until we have some voters who are willing to pressure their elected officials to do something about it, we won't, unless you have a bond market response. And that's could happen at any point. I just don't think, I don't know if it's tomorrow, next year, 20 years from now. This is not sustainable.
Well, lock in your mortgage rates now. Tim, we deeply appreciate you joining us today and shedding light on this incredibly important story. Tim Adams, former Undersecretary of the Treasury and President and CEO of the International Institute of Finance, thanks so much for swinging by today.
Thanks, Jake.
All right, our audience has had their shot of informational espresso and is ready to tackle the day. Next week, we'll have a discussion with President Trump's former envoy, Elliot Abrams, on whether the recent U.S. intervention in Venezuela is a precedent for Iran. Missed a live episode? You can catch the replay on our website, LinkedIn, or on YouTube. You can also listen to the call's podcast edition on Apple, Spotify, or wherever you get your pods. Thank you to you, our members, for joining us today. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.